Okay, good morning, everybody. It's 10 a.m., May 21st, Wednesday, May 21st. It's time for our weekly webinar and our financial focus. Good to see everybody on this rainy day in southeastern Pennsylvania. Our topic today that we're going to talk about during our financial focus is how much do you need to have saved to retire? So this came from a conversation I had with a class attendee. And you know, like many of these webinars come from conversations with you folks, and it really inspires me to have these that present this more broadly because I think it's so important. But we'll go through this. We'll go through the details of this discussion and really how to zero in on that dollar amount at about the 30-minute mark. If you're watching this as a recording or listening to it on the podcast. If you're just joining us for the financial focus, you're not even here yet. So we'll see you in about 30 minutes. I want to remind you of our goals. The goals I have for you as listeners. I want you to be inspired to make changes. We do things differently. I want you to also open your mind to different ideas and different ways of thinking about planning and investing. It's important not to get caught up in these old ways of thinking. We were just talking in the break room prior to this about these sound bites that people talk. They get stuck in. The mindset that people have in their retirement planning, and really what the inspiration was for this video. And people have these sound bites in their head, and one of them that inspired me to come in and write a note that we're going to have another webinar about is, I hear people all the time say, well, why paying tax is a good problem to have. Well, it's not a good problem to have. It's a problem to deal with, and it's if you're just as a foreshadowing here, the discussion was, if your tax problem in retirement is $300,000, well, would you rather deal with it at $300,000 or wait till it gets $600,000? So that's it's not a good problem to have. It's a problem to deal with, and and a problem to make less if possible, right? But we get stuck in these sound bites, and there's many of them. So I may develop kind of a sound bite library and deal with them one-on-one, but try to avoid that. Try to wipe those things out of your head because, people repeat these things to you and it gets you stuck. Accountants, just for example, many accountants will say, why pay taxes before you have to? Well, there's a lot of good reasons to pay taxes before you have to. So open your mind to different ideas and ways of thinking about planning and investing. Stay educated. Stay educated so you feel confident in the plan and strategies that are put in place. Stay updated. Update it so you can make adjustments along the way, because you can't just set a plan for the next 30 years. Even if you have the best plan that's ever been created, the best thing that anyone's ever done, you're going to have to update it. You're going to have to stay on top of changes in the environment. We're talking a lot right now about the changes in tax bills. I just pointed to the TV monitor that's up on my wall. We're going to have a completely new tax bill, hopefully by the end of the year, hopefully very, very soon. But you've got to stay updated. There's going to be things we love in this tax bill. I'm going to tell you, there are going to be things that are going to make us scratch our head and say, what the heck was Congress thinking with this? And then it's going to have to be something that's been dealt with. It's going to have to be dealt with maybe over years from the IRS and changes in regulations. So once again, be inspired to make changes. Open your mind to different ways of thinking about investing and financial planning. Stay educated and stay updated. These are my goals for you every week when we sit down together as a listener. So we're going to go through, we're going to have some Slott updates. We're going to talk about the markets. We've got some really exciting things going on here at Attleboro Wealth Management and our investment strategies that I'll share with you in more detail over the next couple of weeks. But we've got a new person, Chief Investment Officer. Her name's Lydia. I'll introduce you. We'll have a one-on-one at some point. We've got a really great new resources for investment research and management. So I'm excited about that. So we're going to talk about market updates and analyst reports, and then we're going to dig into that financial focus section at about the half an hour marks. And today's topic is, how much do you need? How much do you need in retirement? It's a big question. Okay. So we have some let's talk about some of the things that we just finished. So we just finished a class at Holy Family, and that ended May 13th. And I've been meeting with people coming out of those classes, and that's one of the inspirations for the topic today. But we had the Newtown Theater Wine Walk on Saturdays, so it was a tremendous amount of fun. There were 400 tickets available. 400 were sold, so it was sold out. And I had the pleasure, along with my lovely wife, of serving wine, just 1 ounce servings, give or take, to all the participants as they came in. So we volunteered to serve the wine, and it was really some fantastic wine. The woman, Stephanie, who plans the events at Newtown Theater and is also our marketing director here, did a great job of curating the wines for the attendees. And so myself, my wife, and Terry from here, from Attleboro Wealth Management, all volunteered to pour wine. There are 20 different retailers and other stops along the way. So, like I said, sold out event. We sponsored the event. Attleboro Wealth Management sponsored the event. We are proud and happy to do that to help keep that theater alive. And if you were there, I know you had a great time. If you weren't there and you want to come next year, I'm sure we'll do it again next year. It was just so much fun. Okay, so we're working on some upcoming guests. I've got some emails out about upcoming guests, but we'll get them scheduled. Let's talk about some headlines. So you're going to hear this twice. It's important. So this was part of our analyst report, but I wanted to bring it to you as a headline because you may have saw that last Friday, the rating agency Moody's downgraded the U.S. Treasury credit rating 1 notch from AAA, that's the highest rating, to AA1. Moody's attributed the downgrade to the increasing burden of financing the government's ballooning $36 trillion budget deficit and escalating interest costs. Moody's comments stated, successive U.S. administrations and Congress have failed to agree on measures to reverse the trend of large annual fiscal deficits and growing interest rate costs. We do not believe that material multi-year reductions in mandatory spending and deficits will result from current fiscal proposals under consideration. I want to remind you that our own U.S. Treasury Department puts out a report every year. And as long as I've been reading that report, there's a line in that report that is always chilling to me. And it reads something like, it's very close to this, but I'm paraphrasing a bit. The direction of the U.S. financial system is unsustainable. They use that term, unsustainable. And they talk about things that had to be done to correct it, but it never gets done. So, this is a big issue. The agency projects, back to Moody's, the agency projects that federal debt will increase from 98% of gross domestic product, GDP, in 2024, which is huge, to 135% by 2035, up about 18%, which is huger, right? So that's again unsustainable. And if the tax bill gets approved, it's going to just widen the federal deficit. So anyway, that's a big headline to pay attention to. So what do you do about that? Again, you've got to set yourself up. People ask me, well, are taxes really going to increase? Well, we're going to talk about this in other webinars, but here's another indication. Our rating agencies, and this is the third one now, this is the last shoe to drop that has decreased our ratings for the U.S. Treasury bonds. And there's just a lot of indications and good math that supports the fact that there's only one real way to move the needle as far as funding our U.S. government, and that's individual taxes. So anyway, so let's continue. Let's jump into now the Slott report. So I'm going to share my screen here in the Slott report. And this is from our friend Andy Ives. So for those of you who are just listening or just listening on the podcast, what I'm doing is I'm sharing my screen so you can read along with the Slott report. And the title of this is Check Both Boxes for Tax-Free Roth IRA Earnings. This is tends to be a confusing rule. It's relatively simple. when you think about, there's actually two rules involved in here that Andy's going to talk about, and one is the 5-year rule. It can be very, very confusing if you're younger than 59 and a half. It's pretty darn simple if you're over 59 and a half, but people get caught up in it. So I think Andy does a good job explaining it. And then the other is the ordering rules. So I'll just let the letter speak for itself, or the report speak for itself. But these are two important things to pay attention to. So Andy writes, Roth IRAs follow strict distribution ordering rules. Contributions come out first. So he's talking about withdrawals when he's talking about withdrawals. Contributions come out first, then converted dollars, and then earnings. It does not matter how many Roth IRAs a person has or if the accounts are held at multiple custodians. The IRS doesn't care. All the IRS sees is one big Roth IRA bucket. And within that consolidated Roth IRA bucket, there are only 3 types of dollars: contributions, conversions, and earnings. Any distribution from any Roth IRA follows the ordering rules. Contributions first, converted dollars second, earnings last. So what does that mean? People say if I contribute $100,000, or excuse me, if I convert $100,000 into my Roth IRA, and that grows to $120,000, what is any of that taxable? Well, maybe if you haven't met the 5-year rule. But the $100,000 that you converted, if you're over 59 and a half, is always able to be distributed to you tax-free, because it's a return of what you put in, if you think of it that way. There are different rules if you're under 59 and a half, so you're not circumventing the penalty for taking money out prior to 59 and a half, but we're talking about conversions here. So if you convert $100,000, you can always take it back out and not pay any tax. We're talking about the earnings here. So the earnings, let's just say there's $20,000 earnings. Those have to stay in the Roth IRA. You've got to have a Roth IRA, any Roth IRA, and Andy will explain this, for at least 5 years. If you're over 59 and a half, has to be a qualified distribution. But the IRS will, they see that whole $120,000, but they'll consider any dollars taken out first as contributions, right? The ordering rules: contributions first, converted dollars second, and earnings last. So you'd have to spend through that entire $100,000 and get to that $20,000 of earnings before you even violate that 5-year rule, if you're within 5 years. Now, if you had contributions in there, let's just say you have $20,000 worth of contributions, $100,000 worth of conversions, and $20,000 worth of growth or earnings, then and you take out $20,000, well, the IRS is going to see that. It's that large bucket Andy was talking about, and they're going to say, okay, well, actually that $20,000 we count as contributions. So, that I hope that makes sense as far as breaking down the ordering rules. And those are the rules. So they don't say, well, in this situation, we're going to consider this first. That's it. Contributions first, converted dollars second, earnings last. That's how distributions are counted per the ordering rules of the IRS. So now Andy goes on to write. I just felt like that needed more, a little bit more explanation. So Andy goes on to write, let's focus on just earnings within this aggregated bucket of Roth IRA dollars. Now we're talking about IRAs, not Roth 401ks. I know it's confusing, but the rules are a little different. For the earnings to be tax-free, which is the goal of starting a Roth IRA, a person must check 2 boxes. I like the way he does this. A person must check 2 boxes. Box 1, he must own a Roth IRA, any Roth IRA, for 5 years. The 5-year clock starts on January 1st of the year of the first Roth IRA contribution or conversion. Box 2, he must be age 59 and a half or older, or disabled, purchasing a first home, or deceased. Check both boxes and you're living in a tax-free earnings world for the rest of your life. Assume at least 10 years after your death. Assume a person is 60 years old, never had a Roth IRA before, and decides to make his first entry into a Roth IRA by doing a $100,000 conversion, similar to what I just said. When will his earnings be tax-free? Answer, in 5 years. Until he reaches the 5-year mark, he only checks age 59 and a half box. What if that same person does another Roth conversion 3 years after the first conversion? When will the earnings on that second Roth conversion be tax-free? Answer, after only 2 years. Why? Because 2 years after the second conversion, he will be over 59 and a half and will have owned any Roth IRA for 5 years based on the first conversion. With both boxes checked, the 5-year Roth IRA clock applicable to conversion number 2 disappears. Any future Roth IRA contribution or conversions in this person's life will result in immediate tax-free earnings. Example 1. Tom, age 60, never had a Roth IRA before. Excited by the opportunity to have tax-free earnings, he converts $100,000 from his traditional IRA. Since Tom never owned a Roth IRA, he must wait 5 years before the earnings are tax-free. 3 years later, when Tom is age 63, he does another Roth conversion. This second conversion has its own 5-year IRA clock to wait out before the earnings are tax-free. However, 2 years later, when Tom is age 65, he has checked both boxes. He is over 59 and a half, and he owned a Roth IRA for 5 years. At that point, the 5-year Roth IRA clock applicable to Tom's second conversion disappears, and all his Roth IRA earnings are tax-free. Tom will never have another Roth IRA 5-year clock to worry about. The earnings on any future Roth IRA contribution or conversion will be immediately available tax-free. So here's example 2. Let me scroll up here. Betty was age 55 when she contributed to her first Roth IRA and started her 5-year clock for tax-free earnings. 3 years later, age 58, Betty does a Roth conversion. This conversion has its own 5-year clock. However, 2 years after that, when Betty is age 60, she will have owned a Roth IRA for 5 years based on her initial contribution at age 55, and she will be over age 59 and a half. Both boxes checked. Her conversion clock disappears. All earnings are tax-free. Check both boxes, age 59 and a half, and own any Roth IRA for 5 years, and all earnings in all your Roth IRAs are tax-free. Really, really good point there, Andy. So, the moral of the story here is if you're considering Roth conversions or Roth contributions and you don't have a Roth IRA account, open one if you can. If you're able to, open one, even if it's just for a few $100 or $1,000, just open it up and get that clock started. Many people will say, well, yeah, I've got this Roth IRA and I've had it for 10 years and it only has $10,000. And if they're over 60, it doesn't matter. Now you've checked both boxes. Doesn't matter. Everything you put in there after is going to be 100% tax-free. The contributions, the conversions, the earnings. All right, so the next one is from Ian Berger. So this is your Slott Report mailbag. First RMD year and Roth IRA 5-year period. Here we go again with the 5-year period and today's Slott Report mailbag. So the first question is from a financial advisor. So that our client is, the question reads, our client is 75 years old. He just retired on January 1st, 2025. The company has recognized his retirement date as being January 1st, 2025. When must he take his first required minimum distribution? So it seems that this person is, if because their RMD date today would have been age 73, but if you can have this still working exception, and if you don't own more than 5% of the company and you're still working and you're over 73, you don't have to take distributions from that plan. You still have to take them from your IRAs, but you don't have to take them from the plan, the company plan where you're still working. So it seems as though this person was taking advantage of this still working exception. So now the question is, now that they retire, when is their first RMD? So Ian writes, hi, Rick. If the client actually worked on January 1st, 2025, then his first RMD year is 2025. The RMD for the first RMD year can be delayed until April 1st of the next year. So he could delay the 2025 RMD into 2026, but no later than April 1st of 2026. But if he does that, he would have 2 RMDs payable in 2026, one for 2025 and the other for 2026. It gets tricky if your client did not work on January 1st of 2025 and his actual work day was in 2024. There is no IRS guidance on this situation, but the IRS could say that he actually retired, that is, worked his last day in 2024, even though the company is showing January 1st, 2025 as his retirement date. If so, his first RMD was for 2024, and the RMD was due by April 1st, 2025. If he has not taken the 2024 RMD, he would have to take it ASAP and file a penalty waiver using Form 5329. So this is kind of a big deal. A lot of people retire at the end of the year, and they may be working into their 70s. This is not the first time we've seen situations like this, either questions like this or tax court rulings on this. But what Ian is saying is that be careful. Even if your company said, "Well, we're going to give you a retirement date of January 1st," unless you're working on New Year's Day, there's a potential that you have to take that RMD. That your triggering year for that RMD is going to be 2024, the year that you're still working, and not 2025. You have until April 1st to take it, but here it is. It's May 21st, so this person already missed it, and that's why Ian's suggesting that he file the Form 5329. Take your distribution, file the form, and ask for forgiveness, because the penalty, folks, is 25% of what you should have taken. Now, the rules say that if you resolve it, I think it was within a 2 or 3 year period. That's escaping me right now. It can drop. It can be reduced down to 10%, but it still stinks. It's not as bad as it used to be. It used to be 50% of what you should take. All right, next question. If I made a prior year Roth IRA contribution for 2024 in the spring of 2025, when does the 5-year rule for holding the IRA begin? Great question. So this person made a contribution for 2024 in 2025. You have up till the tax filing deadline. So you can do that with contributions. You cannot do that with conversions. Conversions must be done by the end of the year, the end of the previous year. So this person's asking, well, wait a minute. I did a contribution for 2024, but I did it in 2025. So when does this 5-year clock actually start? Well, here's the answer. The 5-year holding period for determining whether the distribution of earnings is taxable begins as of the first day of the year for which a contribution or conversion was made to any Roth IRA. The contribution you made in the spring of 2025 was for 2024, so the 5-year period began on January 1st, 2024. That's great. So he gets to look back all the way a year and 4 months, and that's when his 5-year clock started. So he already has a year and 4 months in, this person, Phil. But again, that's for contributions, not for conversions. But even a conversion, if you do a conversion, heaven forbid you wait until 12/31/2024 to do your Roth conversion. It's actually considered to be done as of January 1st, 2024. So it reverts back to the beginning of the year. Okay. I hope that was helpful. I love that stuff. It's always good. Now, this is what I talk when I tell you about staying updated. These are really, really good updates. So let's just talk about the markets quickly, because that took some time. So our analyst says our chief investment officer has some comments for us. So this is the week ending Friday, May 16th, 2025. She writes, investor optimism was fueled by a surprise announcement from President Trump early last week, revealing that the U.S. would significantly reduce tariffs on Chinese imports for 90 days. The market responded positively to the potential easing of trade tensions, boosting sentiment and driving gains across sectors. This was a big backtrack here, and I think there were a couple reasons for it. The first is it was killing the markets. The second is I think it was killing the chances of getting this tax bill done, because political clout was reducing by the day. And the most important thing that Congress can do is get this tax bill done. So she goes on to write, the rally came in spite of weaker than expected economic data, including the University of Michigan's Consumer Sentiment Index, which came in at its second lowest level on record. Let me repeat that. The University of Michigan's Consumer Sentiment Index came in at its second lowest level on record. Wow. It's important to note that most of the survey was completed before the tariff reduction was announced, as consumers continue to keep tariffs and inflation top of mind. You can see this tariff discussion was really impactful. In other news, U.S. inflation cooled in April, with the consumer price index up 0.2% for the month, with the annual inflation falling to 2.3, the lowest since early 2021. Retail sales rose just 1.1% in April, a slowdown from March as consumers pulled forward purchases ahead of new tariffs. Stocks rallied last week with 5 consecutive days of gains, pushing the S&P 500 up 5.3% for the week and into positive territory for the year, finishing up 1.8% year to date. The Dow Jones Industrial Average rose 3.5%, while the NASDAQ Composite jumped 7.2% for the week, driven by a strong performance in tech stock. I talked to you already about the Moody's rating that's in here. Moody's was the last of the major rating agencies to have U.S. debt at the top of the rating. As a result, the 10-year Treasury yield was up 0.11% to 4.55% early on Monday, and the 30-year Treasury was up over 5%, its highest level since late 2023. With the news, U.S. stock futures declined. The S&P 500 and NASDAQ futures dropping over 1.5% before Monday's opening, but rebounded throughout the day to end in positive territory by market close. The U.S. dollar weakened against major currencies with gold. This is an issue that I'm reading about every day, is the weakening of the U.S. dollar and the effect globally, and if this, how other currencies may have to step in. Gold prices rose. Fixed income markets, so bond markets, are experiencing increased demand as investors seek safer assets amid economic uncertainties. The Bloomberg U.S. Aggregate Bond Index, which is where most people have their money in that 7 to 9 year maturity area, that is up 2.2% for the year, but down slightly last week. International stocks are outperforming U.S. stocks. We've talked about that a lot. The MSCI World Index, not including the USA, is up 14.35% year to date. Really, really strong. All right. So what we have coming up this week is today we see the MBA Mortgage Market Index that measures volume of mortgage loan applications. The prior index was 11. 11 is she writes is very low. Tomorrow, Thursday, the Kansas City Federal Reserve Composite reflects manufacturing activity in several central U.S. states. U.S. existing home sales we see continuing jobless claims tomorrow, and the U.S. manufacturing PMI. So we'll see where they come in tomorrow, and we'll talk about it next week. Let's see. Many major investment firms have scaled back their U.S. recession forecast following the temporary tariff truce between the U.S. and China. Goldman Sachs reduced its U.S. recession forecast to 35% from 45%. Barclays dismissed recession risks entirely. J.P. Morgan placed the probability below 50%. However, she writes, recession concerns persist, influenced by uncertainty around trade policies and inflation risk. Morgan Stanley maintains a cautious stance. The economists have reduced U.S. gross domestic product growth forecasts to 0.6% for 2025 and 0.5% for 2026, citing ongoing tariff pressures and potential inflationary effects. Listen, don't forget that the tariffs aren't off the table altogether. It's a 90-day pause. So my concern, I'll share with you, is that we're going to see this volatility again in 90 days. So be careful, pay attention, stay educated, stay on top of things. BlackRock warns that they still see tariffs causing further contractions in quarterly activity, but the cumulative impact may be more limited. They're also keeping an eye on early signs of tariffs pushing up inflation. And in another report I was reading this morning from BlackRock, they did talk about how they're basically staying pat with their allocations, even with the potential tariff increases. All right, so let's look at individual markets last week. So the S&P 500, as we reported, was up 5.33 for the week. For the month of May, it's 7.0 up, positive 7.08%. But for the year to date, it's still only up 1.81%. So really strong week, very strong month. So far for the year, 1.81. The Dow Jones was up 3.5% last week. In month to date, it's 5%. So far year to date, 0.89. The NASDAQ had a strong week last week, 7.21. Great month, 10.10. Still down for the year, 0.25%. Let's talk about bonds a little bit. So bonds, kind of the opposite. Down last week, 1.19, or excuse me, 0.19. Down last week, 0.19. Down for the month so far, 1.14. Up for the year, 2%. So that's that Bloomberg U.S. aggregate index. The moral of the story here is volatility is here to stay for a while, probably for the remainder of the year while we're dealing with this uncertainty. So I expect that we'll see if we get a tax bill, we'll see a nice little spike. We start talking about tariffs again in the summertime. We're gonna be probably down in the troughs again. So hang on for the roller coaster ride. So how do we manage these times of uncertainty? Well, not surprising. You're gonna hear me talk about those three pillars. Good asset allocation, of course. So asset allocation is one. You've got to have strong portfolio construction. Two is principal protection, some level of principal protection, something that can't go below zero in your portfolio. It can still give you some good gains. So we want it to be safe but effective. And the third is our account segmentation strategy. And I heard another person, a financial person, talking about account segmentation. So the word is getting out. That was just a term. I didn't make up the process. I just kind of came up with a name. But it's interesting to hear other people start to talk about it. Okay, so it is now time for the financial focus portion of this webinar. So in this section here, we're going to be talking about how much do you need to retire. So like many of these webinars, if not all of the webinars, this came out of a conversation I had with a class attendee. So I teach these classes in different areas and webinars that carry all around the country. And we talk about retirement planning. So this is a really great 6-hour, 2-day course. And people come to me with their questions after. So I love teaching the course, and I really love having these one-on-ones after. So this fellow was saying, we were talking about his goals for retirement. He says, I want 10 million. And I said, okay, well, that's good. It's a good goal. I mean, 10 million, I think most people out there would be happy with that. And I said, how'd you come to that 10 million? And he said, well, that's just what I want. And so I was digging in a little bit, and I said, and we were talking more now. Now, he's about 65 years old. He wants to retire at 70. He has 2 million now, and he wants to get to 10 by the time he's 70. So just think about that for a minute. That's a lot, right? From 2 to 10 in 5 years, you got to either be making a whole heck of a lot of money, and you can put that money aside, or geez, you better hope for some just astronomical, unlikely returns. You've got to hit everything. You have to find those diamonds in the rough. Whatever cliche works for you, you've got to find those individual positions that are just going to skyrocket. So this person had an unbelievable amount of stress because he's put this high goal on himself when maybe he doesn't have to. So as we dug into it, we started talking about, well, okay, how do we really identify a dollar amount? Is it a dollar amount that is it 2 million, 5 million, 10 million? Is it, or is it, and is that driving now what we can spend? Or is really the goal your income and expense needs? So how much income do I need to continue to realize during retirement? Because we all hit the same situation, and all retirees do. You work your whole working years, so we always refer to it as you're a saver and a spender. So you're saving some, you're spending some, and then suddenly during retirement you just become a spender. So you really want to replace that income. It's really what's coming out of your investments you're receiving from maybe Social Security, pension, whatever your income streams are. That's your income in retirement. So what are really the goals? Identifying a dollar amount, 2 million, 5 million, 10 million in this person's case, or identifying your income and expenses that you need. Well, so they're really the two questions. But now let's dig into our feelings about things. What are you really looking for? So now practically, we're talking about dollar amounts, income and expenses, or just top line dollar amounts, 2 million, 5 million, 10 million, for example. And then I said to him, well, what most people really want is comfort and confidence in retirement. You want the comfort to be able to do what you want to do. And you want the confidence to know that you're going to be able to do it for the rest of your life. And he says, yeah, that's exactly what I want. Well, sure, that's what everybody wants. They want comfort and confidence. They want to make sure that, okay, if I'm retiring today, it's May 21st, 2025. Today is my day for retirement. I want to retire in comfort. I don't want to have to skimp. I don't have to worry about going back to work. I don't have to worry about, not shopping organic, whatever your thing is, not taking the trips, not doing that. I want to have a comfortable retirement. Now that might be, it's very, very different for everybody, of course. And if we have time, we'll talk about that a little bit. But now that we know that the goal is truly to have comfort and confidence in your retirement, well, then to me, it becomes pretty simple. Because now if the idea, and I'm sharing my whiteboard now for those of you just listening, and I've got some outlines here. I said, what is the goal? We just talked about that. Identifying a dollar amount, whether it's 2 million, 5 million, or 10 million. Here you go. Or expenses and income. Making sure that now that I'm a spender, that I can do all the spending I want to do and pay for the things I want. Well, once we identify that the true goal in retirement is comfort and confidence, I think it becomes obvious what the dollar goal is. The dollar goal comes back to expenses and income. Because if we can, this person said that they wanted to spend $200,000 a year, and that's an after-tax number. That's a 2025 after-tax number. Now, we're going to talk about that a little bit too. But if he can spend $200,000 a year, and he can do it with only $2 million, does he need 10? No. Not if his true goal is comfort and confidence, which is what most people's goal is in retirement. Now, there can be a lot of different goals around that. I'm not saying, you're just living in your feelings. It can be, well, I want to, everything that can be involved. I want to do the spending I want to do. I want to travel. I want to buy a vacation home. I want to leave $1 million to each of my kids. Whatever your individual goals are that build into that, my comfort and confidence in retirement, that is all important and valid and all part of it. But fundamentally, it comes back to this: comfort that you're going to be able to do what you want to do in retirement, and confidence that you're going to be able to do it for as long as you're alive, and meet those goals. So that goes back directly to expenses and income, as I said, because if you need 10 million to have your comfort and confidence and to reach those spending goals that you want, then that's your goal. But if you could do it for 2 or 5, why would you strive for more? If you end up with more, that's great. But in this person's case, when I said that to him, I saw the ease, even across the camera. We were on a Zoom meeting. Even across the camera, I saw the ease. Now, I'll share with you that ease in people's eyes or even their body is one of my favorite things, because people hold a lot of anxiety about retirement, and it keeps them up at night. It makes them probably not have that as much time here on this planet because of the stress involved in it. But once you see people ease and say, oh, well, that makes sense, because I can suddenly see the wheels turning, that he was saying, well, maybe he doesn't need $10 million. Maybe he can do it with 5, and 5 from 2 over 5 years is much less. But geez, what if he could just do it with 3 or 2.5? Because if the goal truly is $200,000 after tax, that is much more achievable when you consider pensions, Social Security, withdrawals from your savings, than just shooting for a $10 million goal by the time you retire in 5 years. $200,000 spending is much more doable. Now, there's so you can now that you know what the goal is. Now, how do you reach that goal? So you become clear on your focus. You identify true needs, goals, and potential issues. So you've heard me talk about this. We have a process we walk through with people in their financial planning process. So we've developed a spreadsheet that we use for expenses. We've developed this over the last 20 some years. I've been doing this, that really helps shake those trees, because it can't just be, so this person's, this is very common. This person, let's just carry this down. He said, I want to spend $200,000 a year after tax during retirement. It's almost never that. It's almost never that. There's a couple different reasons it's almost never that. First of all is most people don't track their expenses that closely. It's usually just a guesstimate, and guesstimates are not good. Even if you're the engineering type, we have a lot of clients as engineers. I've talked about that, or who are engineers, and they come to us and say, I've been tracking my expenses for the last 35 years on a spreadsheet, and I'll share that spreadsheet, and you'll see I know exactly what we have to spend. Rarely is that truly the whole picture. Many times taxes are omitted, or certain surcharges, things like that. It could be one of my favorite ones is pet care. People often say, "Oh, I didn't realize I spend $5,000 a year in pet care." But become clear on your focus. Identify true needs, goals, and potential issues. This is where we really help here. Well, we help with all of it. Identify the true needs and goals, because 200,000 might be 220,000, might be 250,000. So you've got to identify all that. You really have to shake those trees. And there may be many things, even if you have your 35-year spreadsheet, there may be many things that you haven't even considered. Things like higher taxes, because most financial planners, most financial advisors aren't even allowed to talk about tax planning. Things like higher taxes, things like Medicare surcharges, things like, heaven forbid, dramatic market losses or high investment expenses. You've got to identify all these potential issues. Then you develop an investment savings strategy to fund your needs, goals, and issues. So you've got to get clear on it, clear on that. What's your goal? Become clear on the focus. Identify true needs, goals, and potential issues. Really shake those trees. And then develop an investment saving strategy to fund needs, goals, and issues. So I have savings in parentheses there, because if you're retired already, you're done saving. But if you're still working, you need an investment and saving strategies. Then you have to stress test these things. So it's not uncommon for us to see, well, geez, you see some kind of chart in a financial plan. So here's your financial plan, and it shows, well, here's retirement for you, and here's your date of death. Let's just say 95. They project out to 95, and look at this. If you continue to save, well, geez, you're gonna have $10 million. There's his $10 million number. You're gonna have $10 million by the time you're no longer here. Well, the problem is that most of these plans and most of these planners fail in a couple different areas. Well, first is they never truly identify the needs, goals, and issues. They just say, oh, you say you need to spend $10,000 a year? They write that down. They put that into their system, into this planning software. They don't really identify, do the work. You have to do the work to identify that $10,000 really might be $12,000 a month. So you've got to do the work first. The second thing is they don't really look at the stress tests. So oftentimes they'll look at the market stress test. What if we have some negative markets, and they use that Monte Carlo, simulation? We do that too. Monte Carlo is important, but a market stress test, for example, sometimes brings us down to here where you've got risk of running out of money. Sometimes it may bring it out here where you say, okay, instead of $10 million, you potentially have $1 million at the end of your lifetime. If we have some negative markets that are at a bad time for you. But then we also want to look at, what if we have higher taxes? Again, this is one that usually isn't talked about. Now, that is another stress test that pulls us down and gives people a risk of potentially having less money to spend in their lifetime, maybe running out of money, or, being able less money to do what they want to do. And then lay over both of those potential market fluctuations, a repeat of the Great Recession, for example, and higher taxes. We see a lot of really pie in the sky, rosy glasses kind of, rose-colored glasses kind of plans suddenly start to struggle. So you've got to, you have to do the proper stress tests. And you've heard me say this, this isn't on here, but you have to do this every year. You have to go through this process every year, this financial planning, really shaking the trees process. Now, once you have that developed, you come up with, now you've got your savings and investment strategy. So some popular withdrawal strategies we're going to talk about. Well, the first is the 4% rule. So we go back to sound bites. I talked about sound bites at the beginning of the webinar, so the weekly webinar. So if you wanted to listen to the weekly webinar, you can go back and listen to that if you're just listening to the Financial Focus. Oh, and by the way, I've got a note here. If you like this video so far, or you like my videos, please remember to subscribe. And if you like them, maybe a like would be nice. And if you want to be notified of new videos, hit that notification button as well. But the withdrawal strategies. Let's talk about withdrawal strategies. So we have this 4% rule. So the 4% rule looks something like this. Here's the time that you retire, 2025. This goes out all the way until you're no longer here, right? That's the goal. And they say, let's use $2 million, for example. You have $2 million. And if you don't withdraw more than 4%, depending on how you're invested, then you shouldn't outlive your money. So, and that 4% rule actually should be adjusted for inflation. So I'm just going to say adjust it for CPI, Consumer Price Index. Let's use that as inflation. So what that takes us is $2 million a year, $80,000 before tax. And it's really a straight line. So you get to spend off that $2 million, and it's not just earnings, it's earnings and withdrawals. $80,000 adjusted for inflations over your lifetime. So that might be completely fine for you. Is it fine for the person that we talked to? No. Remember, his need that he said was $200,000, and we don't even really know if that's the real need yet. But the 4% rule could be too limiting early in your retirement because he's got things now. He's got a gap. Let's say he gets $40,000 worth of Social Security. So that takes him up to $120,000 a year, and he still is not meeting his needs in retirement. He's still not feeling that comfort and confidence in his retirement. He might be confident that he's going to have money at the end of the year, or at the end of his lifetime, if in fact the 4% rule works out, which I would argue, carries a lot of risk. But he doesn't have the comfort in his retirement because he's not doing what he wants to do. He's keeping himself to this $120,000 a year. So the 4% rule is one of those sound bites, things that people feel some level of comfort in because they've heard it so many times. But the reality the reality of financial planning is, over my more than 2 decades experience, is that most people's savings or spending look more like this. So there's things you want to do early in retirement. So these are the early years of retirement. There are things you want to do in those early years of retirement. So you're going to spend more. You're going to you not only have your basic expenses, but you're going to want to travel. You're going to want to visit whatever your goals are, whatever's going to bring you that comfort in retirement, and acknowledge that all the work you've put into this is worth something. So there are things you want to do. So we do slow down. We do tend to slow down, and there's been references to these are your go years, these are your slow go years, and then these are your no go years. Because if you retire at 65, let's just say, that's a pretty straight that works out. Slow go, no slow go, no go. But again, these are sound bites. We like jingles in our head, right? We like to hear these things. But the reality is that while you may slow down here, and this takes us to like 75, 80, let's say, while you may slow down, maybe you're not traveling as much. I'll tell you that the retirees I know a lot of them, they're still very, very active, well into their late 70s, 80s. My own mother-in-law is 85 years old, and she does Pilates several times a week. She's always doing something. Even though she just had her knee replaced, she's still very, very active. But and even we may slow down a little bit, but then as we age, we increase our costs, and that is usually due to medical. So this is really what you have to plan for in retirement. So you can plan to spend more. Maybe he gets up to $200,000 a year. If that's truly his number that he can spend, that drops down. And then we also have to plan for this to be able to pick up. So how do you do all of that? Well, the 4% rule doesn't work, right? Because it's this linear one. Just, hey, let's just live off of just budget in the beginning what we have, and let's hope it lasts, based on this rule. And the 4% rule was made up by a financial advisor way back in the 90s, by the way. So it's not in my opinion, a well-proven strategy at all. There's been a lot of people who say, well, it should be 3%. Not about 10 years ago, there was conversation about 2.5%, but really none of those, in my opinion, are the way you should be doing things. And then you hear some people talk about, I've heard this a lot lately, well, I'm going to live off my interest and dividends. So living off your interest and dividends carries a tremendous amount of uncertainty and risk, because the dividends and interest you're getting today might be significantly different than the dividends and interest you're getting in just 6 months. So, you can still get a 4.25% money market today. I saw, I got a report yesterday of some annuity companies that are paying 5.25% over the next 5 years. I don't know how long that's going to continue. Interest rates are still inflated. When we get some stability in the economy, it's likely to balance back out to lower interest rates. But the thing is that it carries a lot of uncertainty and a lot of risk when you're just living off of interest and dividends for not only your investment, but your earnings. I was talking to a fellow yesterday. He said, I'm thinking about switching to high yield bonds to get more interest, but I don't want to take a lot of risk. Well, high yield bonds are junk bonds, corporate junk. So lower rated, more risk, right? So that less ratings, more risk you have. They don't want to call them junk bonds, so they call them high yield bonds. You get higher yield, you get that higher interest because you are taking more risk. That's why you get more interest, because you're taking more risk. That's all well and good if that's what you want. But you better understand what you're getting into, because those corporate bonds can default. They can stop paying. They can do, there's a lot of things they can reduce. There's a lot of things that they can do. So what you hear us talk about a lot is this account segmentation. So account segmentation makes sense to me, because if we take this same timeline, so we start here in 2025, if that's your retirement date and your goal is to have money here until you're no longer here, we break up the funding into segments of time. So it's typically 0 to 3, 4 to 6 years. These are years. 7 to 9, 10 to 13, 14 to 17, and then 18 plus years. So I'm not suggesting that you're going to pass away in 18 plus years. This is just, what this sketch allowed for. And then you figure out those needs, goals, and issues, those expenses and the income, what's going to bring you comfort and confidence during that time. So let's just start with comfort. So if your comfort is, in this example, $200,000 a year, for the, in the beginning of your retirement after tax, well, we want to fund 3 years. So that $200,000, you're going to need $600,000 here. And then in the next 4 years, you spend time, you do the work, you have to do the work. You figure out, okay, because some people say, I'm probably going to spend about $10,000 a year on vacation, but the first 3 years, I want to spend $30,000 a year on vacations. So your cost might be higher in those first 3 years. So maybe you need $600,000 in those first 3 years. Maybe you only need $300,000 in those next 3 years. But heck, let's call it another $600,000. And maybe you need another $300,000 here. Maybe you need much less. But these dollar amounts continue for each of these segments. So the first question is, well, how do we figure out how much we need in each segment? Well, you figure out your segment funding by proper financial planning. And it has to be reviewed every single year. That's how you figure out your funding amount. Now that you figured out your funding amount, now you can take your bucket of money, your $3 million, for example, and instead of just counting on a single allocation with those $3 million, of funding that entire period of time in your retirement, you spin off different investments, different accounts to fund each one of these segments over your lifetime. Most conservative over here, growing more aggressive and growth oriented as we reach out later in time. So you've got this is very little or no risk. This increases your growth as you go out. And then once you have that established, these separate accounts are set up to fund each one of those time periods. Now, once you have that established, can you set it and forget it? Absolutely not. You have to continue to shift your investments down to fund each pocket of your time, each segment of your time. And each one of those little portfolios demands a lot of focus and management to make sure that the asset allocation, the investment selection is appropriate in each one of those. So that is account segmentation. So in a very quick nutshell, because we're almost at the top of the hour, if you want to learn more about account segmentation, you can dig into it, and we'll put a link here for our 3 pillars video that, again, we just seem to be talking about this all the time. The reason we talk about it all the time is because there's a tremendous amount of uncertainty, and it applies. Because if your funding is laid out, you know exactly where your first $600,000 is coming from. You're getting a good interest return on that, and you're getting some earnings, but you're taking no risk. And if the market drops 40%, you know that I'm going to be fully funded for this, and I can do the travel, I can have the fun, I can do all those things. That's going to give you the comfort. The next segment over here, 4 to 6 years, you're not going to start tapping into that segment for another, until year 4. That may have a little more growth opportunity, therefore carry a little bit of risk, but it should be a very, very tight margin. There are things that we do to minimize risk in those portfolios that I can't get into now. But that's going to carry much less risk than just the general stock markets or even bond markets. And so, you're looking at this, your funding is coming from these 2 segments for the next 6 years. So that increases the comfort. Now you see you have these individual accounts that are allocated appropriately for you because you've identified these numbers. You've put in the work. You've identified the numbers of what you're going to need to fund your entire amount of your retirement. And maybe you have some left over that we call legacy longevity. Often this is hundreds of thousands of dollars, if not more, that's available for you if you need it during your lifetime, but will probably pass to the next generation or to your heirs. So you've identified what you need during your lifetime, plus other money in most cases that you can tap into if you need to. So it brings you the comfort and it brings you the confidence that you're going to have this for the rest of your life. And it's appropriately set up, not of, oh, heaven forbid, I'm going to try high yield bonds and see if that works because I've read about it and it may make sense. Maybe not considering all the risks involved. So I'm not being critical to that. If that's coming off as critical, I apologize. But I'm not being critical to that person. But this is what people do. So doesn't that make more sense? Isn't that this is designed to give the comfort and confidence you need during retirement? Because that, folks, is truly the goal. It's a little bit of a trick question, right? How much do you need to retire? You need the amount that's going to generate the income and expenses laid out appropriately. The income and expenses that you identify, you got to do the work. You really have to become clear on the focus, identify true needs, goals, and potential issues, and then develop your strategy once you have that. Because the true goal is comfort and confidence. Comfort that you're going to be able to do what you want in retirement, and confidence that it's going to last your lifetime. Okay, so that, my friends, is the financial focus for today. I hope that was beneficial. I hope you learned something today or reinforced maybe something you knew before. Even if you've heard this discussion before about the account segmentation process, financial planning process, identifying goals, it's always good to review. I had a client who's been a client for 5 years in our recent class at Holy Family University. And he said, it was really good to sit through this because it just reinforced, I remember sitting in this class 5 years ago and I understood some of it. Much of it went through me because there's a lot of information. And I understand that the things we deal with in financial services industry and wealth management and financial planning are complex. This stuff is not easy. Even if it seems simple, it is not easy, especially staying on top of it and doing it the right way, in my opinion. Managing taxes, doing all the things that we do. So reinforcement is really important. So I don't mind repeating these things. Repetition is important. It's important for you to stay on top of things. It's important for you to keep your mind open. It helps you. It helps you push away these silly sound bites that we hear. So I hope that was helpful. I hope you got a lot out of that. I'd love to hear your feedback. I see a question here. Let me take the question quickly from Roseanne. Mark, when you take a distribution from either traditional or Roth, is it the IRS who is tracking whether the money is applied against the order of distributions, beginning with your contributions? Roseanne, so we're talking about Roth when we're talking about ordering rules, and it's automatic. They don't track it. It's just how they consider it. But good question. And that goes back, folks, if you're listening to the Financial Focus only, that goes back to our Slott report mailbag and a report we did earlier in the weekly webinar. If you want to go back and watch the weekly webinar, please do. That's a full hour of we talk about some IRA distribution issues and updates, and then we talk about the markets, and then this last half hour is typically the Financial Focus. But I hope you all have a great week. I hope this was helpful for you, and I look forward to seeing you next week. Take care.